welcome everyone to our property market update today. We're just waiting for, got quite a large number of participants or attendees today, so we're just waiting for everyone to register and then we'll get started. Let me introduce our guest speaker today, who should be familiar to many of our guests. I guess we've had David present to us a number of times before. David McMillan is the CEO of Performance Property, which is a property research and investment advisory firm. And we've been fortunate to have David working with us and our clients for many years now. David's got a range of experience, which you can check. But I think the thing that's most valuable from FMD's perspective is the deep level of research, qualitative and quantitative, that Performance Property put into the Australian property market. And that's why we value David's input into these things. There are a lot of experts in individual markets and perhaps buyers advocates and so forth in a local area, but very few organisations and perhaps none with the expertise that we have from David. With that as an introduction to you, thank you very much for joining us again. Obviously, we've got a lot of interest today. Interest rates are rising, having impact all over the place, not just on property markets, but I might stop sharing and hand over to you to take control and share your thoughts on the property market at this point. Thanks.
So here we go. Another disclaimer. So everything that we're preparing today is general information only. If you want specific advice, speak to your FMD broker or speak to one of our team one-on-one. Today, we're going to give an update on the national property market, hoping to generate a bit of Q&A at the end based on what you're thinking at the moment. There are a number of big things to cover, but before we do, I just want to highlight the movement in the market since COVID. And I think we presented early days, Lee, after COVID and said the market was going to go up when the media was saying the market was going to go down. The view was the market may fall 40%, 20%. And if you look at what happened, it was almost the opposite. And the reason why we came up with those views was just analysing the fundamentals. And we weren't getting carried away with sentiment. We're just trying to predict the most probable course forward. When we look at the big story at the moment, it's obviously interest rates and inflation. This inflation number is dated. Luckily, we had an inflation number that came out yesterday that was lower, which is very encouraging. It tells us that interest rates may have peaked or interest rates are peaking. This is a significant step for the property market because it's creating a lot of uncertainty with buyers and investors. They're sitting on the sidelines, not doing anything because they don't know where interest rates are going to settle. For the purpose of this presentation, the forecasts that you'll see are assuming a cash rate of 3%. So our investment committee and our research team is putting together forecasts based on a cash rate of 3%. So that's our view. That's where we think the cash rate will settle. And of course, if the cash rate doesn't settle there, then obviously our forecasts are going to be wrong. But in terms of being able to forecast property prices, you need to be able to have a view of where we think interest rates are going to settle. So, and we can talk about that a bit more at the end. This is the major factor in the market at the moment, interest rates, because they've risen so sharply. They've risen obviously because inflation's risen sharply. It looks like the trend of inflation has changed. Hopefully we're seeing the peak of the interest rates this year, and hopefully we start to see interest rates come off towards the end of the year, and that will help with the sentiment issue that's going through the property market. What happens when there is a sentiment shift and what happens when debt becomes more expensive is less people want to borrow money. It's almost that simple. And this is a great graph because it tells the story of what's been happening post-COVID. So 2020, a rise in lending activity. And then once the interest rate cycle started to go up, a decrease in lending activity. And this tells you the future of property prices because in order for people to buy property, they have to borrow money. And so this graph is 3 to 6 months ahead of the market. And so you can see which way this graph is telling us that markets should go, and that is at a national level, sideways or down. This data is produced at a national level, but also on a state level, and every state, with the exception of WA, has the same trend. Okay. The other major story, and this is the story that's going to stick with us long after inflation is controlled and interest rates normalize, is that we are sleepwalking into one of the biggest undersupplies that the market has seen, comparable but possibly worse than the early 2000s. And for those people that were renting in the early 2000s, there was double-digit rental growth 4 years in a row. And that's what we're predicting is going to happen or worse. So we're predicting 3 to 4 years of double-digit rental growth. And the reason why we're predicting that is because we haven't been building enough. And that's evidenced by the vacancy rates in every major regional town and every capital city trending sub 1%. These are the regional towns. As you can see, the vacancy rates all trending down over the last 5 years. And when we look at the capital cities, let me go back. They were the capital cities. And these are the regional towns. It doesn't matter where you look. There's no stock. There's no bedrooms. Rents are rising. And we've heard recently the media pass commentary on that. I don't think that's going to go away for some time. And the reason why is because we haven't been building enough for a long period of time. We look at the dwelling approvals and the trend. It's almost flat. And these undersupply situation has come about at a time when 2020 and 2021 and 2022 were characterized by no overseas migration. This is our overseas migration numbers. You can see they are storming back up. Just wondering if you can see that like I can see that. We've got a rolling 90-day forecast for migration for 2022. And obviously, we're getting huge numbers back. And this is putting pressure on the rental market. And this is driving vacancies almost to zero in certain markets. That means only one thing, and that is rents will rise. And where prices can rise, they will also rise when sentiment shifts to a neutral or positive setting. That will come when cash rates normalise. We can talk about that more at the end if you like. But just to recap on this and the significance of this, the line that you can see there is the unemployment rate, and the green bar graph is the overseas migration numbers. And what we know is when our unemployment rate is low enough, we always get our overseas migration quota. So we're looking at between 200,000 and 300,000 migrants every year in this low unemployment rate. Combine that with natural increases in migration, not enough stock going into the pipeline. It's a recipe for positive rental movement, which will lead to positive price movement. We're going to start with Sydney. And the reason why we're going to start with Sydney is because Sydney leads the market. It always has historically. And the Sydney market peaked. And the reason why that is significant is no city or town ever goes past Sydney. The median price of Sydney sets the benchmark, the high watermark for the country. And the market has peaked and it's in correction. So what that means is this cycle, it is highly likely that no capital city or regional town will get past the median price of 1.3. That is the destiny for the medium term for each one of those markets. You can see the Sydney market bottomed in 2012. It was 550 here, went to $1 million in 2018, and then COVID hit, and it got this low interest rate fueled bump. And what that low interest rate environment gifted Sydney, it may take away. So that's something that we're seeing right now. And the reason why I say that is because when we have a look at the affordability index of Sydney, the affordability index, so this measures the percentage of the average wage that goes to the average mortgage repayment. Okay, the percentage of the average wage that goes to the average mortgage repayment, assuming an LVR of 80%, and the current standard variable rate principal and interest mortgage. This goes back to 1980. You can clearly see that when Sydney gets above 60, the median price in the subsequent years comes off. In 1989, it got above 60. The median price in Sydney came off. 2004, it got close to Sydney and the median house price came off. The green line graph here is the year-on-year price change. In 2008, it got above 60 and the Sydney market came off. In 2012, the Sydney market got to 60 and came off. In 2017, 18, it got above 60 and came off. You can have a look at where Sydney is now. It's had an affordability index of 76%. It's never been that high before. And property in Sydney for houses is just simply unaffordable. People won't qualify to get funding for where current prices are. And so using this as a tool to forecast prices, we think the Sydney market is probably going to come off a further 10%. Now, the Sydney market peaked at 0.475. It's down at 1.3, and we think it'll probably settle at 1.2, 1.25. So if you bought at the peak in Sydney, you could be in negative equity by the time this process makes its way through. And it's significant for those that watch the market and are interested in the market. On the flip side, Sydney has a low vacancy rate, and you've seen rents go from 630 to 900 a week for houses. Huge rental growth. Because, of course, if people can't afford houses to buy them, then they must rent them. And if they can't afford houses to rent, then they can buy apartments, they can rent apartments, or they can leave Sydney. And what we've seen is people leaving Sydney. And that's very characteristic of a peak in prices in Sydney, where you have a massive exodus to regional areas and interstate migration. We do think the Sydney market will be robust, in the sense that we do think it'll come down to a median price of 1, 2.5 and be robust. And that's because the jobs growth data is so strong and the population growth into Sydney is so strong. So what we think is going to happen in Sydney is further rental growth on both units and houses, price growth on units, and houses sub 10%. That's the forecast. In terms of Melbourne, Melbourne median price 910. If you look at Sydney and say Sydney's going to settle at a median price of 1.2, we can argue that Melbourne's got a bit more to go this cycle, and I think it will go. Our view is that when interest rates settle, Melbourne will probably jump another 15%. Melbourne will probably jump to a median price of 1 to 1.1, and it will arguably settle here until wages catch up. So we're not as pessimistic about Melbourne as we are Sydney. Melbourne has limited growth. It's not somewhere where we're buying for investors. The affordability index is right up there. It's at 53%. But of course, we're seeing a little bit of price softening. And as interest rates come off, this will probably drop down to 45. And then we'll see the market kick up a little bit. Melbourne typically corrects around that 50%. When you go back through history, Melbourne, when it hits 50%, it comes off. So the reason why the market's in a bit of a holding pattern at the moment is because with current prices and current interest rates, the market doesn't really make sense. But if you get a 100 basis point discount or 75 basis point discount off the cash rate, the Melbourne market will be somewhat affordable for some people and will probably rise a little bit more. In terms of the undersupply situation, we're finally getting our overseas migrants back. We're finally filling up our universities again, and our vacancy rates dropped, and you can see our rentals have gone up, not as much as Sydney. Sydney's gone from 600 to 900. Melbourne's gone from 520 to 645. Right. So Melbourne, our forecast for Melbourne is we will start to see much stronger rental growth in both houses and units. And we're probably going to start to see some really strong growth from Melbourne units, arguably 50% growth over the next 4 or 5 years. We haven't had unit growth for a decade, depending on what your unit is and where it is. But certainly in the high density space, there's been no growth in about 10 years. Again, we're not expecting Melbourne to be a soft or fragile market. Jobs growth data is through the roof. Therefore, our overseas migration numbers will be strong. Therefore, we sort of have a fairly high conviction that rents will rise on houses, rents will rise on apartments, apartments will rise, and houses have a little bit more in them to go this cycle. With respect to Brisbane, Brisbane median price of $750. We think the Brisbane median price will probably get to about $1 million. There's affordability in Brisbane still. Southeast Queensland is the fastest growing area in Australia. There is affordability in that market, affordability index of 44%. There's nothing to buy up there. This is the stock on market numbers, and this is the days on market numbers. So the market in Brisbane and Southeast Queensland, for that matter, is still trading pretty well, with low stock volumes, fast days on market, and somewhat affordable property. You can see the vacancy rate is sub 1%, and we're seeing more aggressive rental growth in Brisbane than Melbourne. Rents have gone from $470 to $668, and we're forecasting that will go higher and higher, probably into the 800s, maybe even the 900s. So significant rental growth to come. Job vacancies, again, is very strong in Brisbane. So it's going to be a very robust market. We probably see that market as 30% to run, and I say ish. We've purchased, I don't know, maybe 800 houses in Sydney. Most of those were done pre-COVID, and most of those clients have done very well. When we move over to Perth, this is where we're directing 75% of our client flow. This is where we see value. You can clearly see that there's been a huge stagnation in Perth property prices from 2008, median price of $460 up to $550. Okay, so the Perth property market only 25% up over the last 12, 13 years. Now, Perth, when it goes through a cycle and gets going, is second to Sydney in terms of the median house price rankings. Right. At the moment, Bendigo, Ballarat, Hobart, and a lot of other regional towns are more expensive than Perth. So Bendigo and Ballarat are more expensive than Perth. So if you get your head around that, it's a quite important point. People in WA make just shy of what people make in Sydney. So we've got very high income, very low prices. We have an affordability index of 30%. And of course, when interest rates come off a little, that'll probably drop down to 24, 25. And so we're anticipating very strong growth comparable to this period here, which was 0107, where prices went from 150 to 460. We think prices are probably going to go to 500 to 900, maybe 500 to $1 million, something like that, once sentiment shifts. Perth, low stock on market, very low days on market. It is a market that is still rising, even in the face of we don't know where interest rates are going to stop. The market is still rising, which tells you how much confidence there is. The vacancy rate is almost zero. There is nothing to rent over there. We manage about 500 properties now, and those properties have queues around the corner, and we're asking, like, what we're anticipating we're going to get when we buy it and what we get when we settle on it are two different numbers in the positive. That's how quickly the market's moving. So rents have gone from 430 to 662, and as I said, on a vacancy rate of zero, which is very significant. Jobs growth data in Perth is very strong. So we anticipate that vacancy rate will remain low for some time. Rents will grow, prices will follow. It's not a market where we buy and hold WA for obvious reasons. It goes through incredibly long stagnations, but it is the market right now that we're buying and selling with a 5 to 6 year view, hoping to pick up 50% growth for our clients. So for those of you who haven't seen this before, this is our view of how markets work. There's a growth phase and then there's a correction phase. The growth phase typically lasts 6 to 9 years in length. Markets may grow 50 to 150% depending on the macroeconomic cycle. Markets peak, like Sydney at the moment, it's too expensive, and they go through a necessary correction where wages catch up. In context of that cycle, here's where all the markets are around the country. And you can clearly see that the towns in the buy value stage are majority mining towns, but this is where we think the money's going to be made, and this is where we're directing our clients in a residential setting. Units, a bit different. There's a bit more value in units around the country. And depending on what you're holding and what your strategy is, we can talk to that on a specific basis, but there is more value in units than houses at the moment. When you look at houses, a lot of the markets are peaking or close to peaking right now. When we look at our forecasts, our forecasts are scenario 1 here. So we think the cash rate will settle at 3%. And so we're looking at this forecast chart here. So on that basis, Adelaide can run 20, Brisbane can run 40, Canberra can run 7, Darwin 50, Melbourne 9, Perth 102, and Sydney -7. So even if the cash rate falls, we think Sydney will still fall. So it's quite a pessimistic view for Sydney. When we look at the regional towns, and some of these regional towns, interest over here in scenario 1, you've got Bendigo and Ballarat with 25% growth, Geelong at 8, Toowoomba at 43, Ipswich 42, Rockhampton 74, Rockingham 90, and Sun 25. So it's no surprises where we're hunting at the moment for growth for our clients. It's Rockingham, Rockhampton, and Perth. The strategy is very different. It's not a buy because these are different markets. It's a buy and sell. It's try and generate 50% growth. And then we're selling, we're paying the CGT, we're getting a lump of cash and we're paying that off debt somewhere or reinvesting it somewhere else. In terms of commercial, obviously as there was no money in term deposits or bonds, commercial property went crazy post-COVID. Yields, we had significant yield compression on AAA properties to the point where quality commercial properties were selling on 3% yields. So there was really no premium for risk, and it was a highly competitive market, probably the most difficult commercial market that we've seen because we didn't buy that much because we couldn't. At the moment, we're wanting 6% plus yields, and vendors are still wanting to sell under 5. So there's not much going on still, but we're starting to see now that the commercial market is opening up, and we are getting net yields of 6 and 7%. On quality defensive commercial. It takes about 6 months to find a commercial property that's good enough to buy for our clients, but we do find it. It is part of our business. We're probably doing a couple of $100 million now in commercial transactions a year. Obviously, with interest rates moved significantly from where they were to where they are now, yields should be softening, and they are, but it's happening very, very slowly. It's not happening quickly. It's happening slowly. Our target for defensive income, like a Centrelink or a WA Police Command Centre or something like that, is about 6.5%. If we can get that, we're fairly happy. Our commercial strategies, because we think the apartment sector is going to go through significant growth, we like development sites with a commercial tenant where we're picking up net 4%, net 5%, net 3%. We think they're really good bets at the moment, and we've done a number of them from 3 mil all the way up to 10 mil. We're always trying to find defensive AAA government tenancies on net 6%. That's just a standard that we run for our clients and for our syndications. And we're also always on the lookout for strategic partnerships with government entities to produce that low risk yield in a commercial setting. So the summary, hopefully I'm on time. Look, rising interest rates will produce headwinds across the country to all markets. I mean, I don't think that's anything new. I think everyone understands that, but it's not like it's just the residential market that's suffering. It's all markets. The forecasts that we've put forward are assuming a cash rate of between 2.75 and 3. Now, some may argue that's optimistic. That's okay. We can argue about the cash rate all day long. We have to draw a line in the sand with the information that we have and put some forecasts out based on where we think the cash rate will settle. And we're not saying the cash rate will get there down to 3% in 2023. We're saying over the course of 2024, 2025, the cash rate will probably settle somewhere at that level, which will produce that possible runway for those markets. Hopefully I've demonstrated today the biggest story, which is the housing market is completely undersupplied and the building industry has serious problems, and we're not producing enough bedrooms. And ultimately that's going to result in more homelessness, rapidly rising rents, and big problems for governments that they're more or less sleepwalking into. There's a whole range of things that they could be doing now, such as incentivizing stock through stamp duty waivers, incentivizing foreign investment. These are easy things for them to do, and they're just not doing it. And it's going to produce a huge problem. And I've never seen it this bad in the data. with the dwelling approvals mixed in with the vacancy rates. So rents will rise. It's good for investors. It's bad for other stakeholders in the community, but it is good for investors. And in that regard, whilst there is this cloud hanging over what's happening at the moment, we do believe there is great opportunity to buy residential growth investments in those markets that are outlined, but with a specific strategy, not just buy it and hold. There's a specific strategy. We think the national markets are going to peak 2025, 2027. Significance of that is we probably won't be buying a lot of residential property past 2024. We will mostly only be buying income-producing assets on net 6% yields or higher. We've already conditioned our clients that we'll be doing a lot of selling during 2025, 2027 of residential properties. And we're wanting our clients to have lower debt-to-income ratios during this period, cash flow positive property portfolios, and higher than normal cash buffers, capitalise on what is typically a bit of a credit on the other side. It's just a view that we have. It might not be supported by everyone else, but that's what we think. And that's what we're sort of preparing for. And here are some things that we buy, just so people can understand. So this is a house in Perth. That's what it looks like when we buy something for a client. It's just a house in a quality suburb. This particular house, hopefully it gets to 1.5 or 1.75 million in 5 years and we sell it, because that's the strategy. There's a house in Rockingham. This was on a 6.4% gross yield. It's obviously not pretty, but it's going to work. We feel this is what we've done in Bendigo. This is what we've done in Ballarat. This is what we've done in Geelong. These are the things that have worked for our clients. When we look at commercial, this is the sort of property that we buy directly for our clients or in a syndicated format. This is a police command centre in Western Australia, in the northern suburbs. This is an example of a development site with 6 levels of upside in Brisbane. So it's producing a 4% net return whilst we're sitting on it, but it's got the potential to put 6 levels of apartments above it, which we felt was a good deal for one of our clients. And this is just the lower end commercial property, which is an allied health facility. We probably bought this when the market was peaking at a 5% yield. We've never gone below 5% for clients.
Thanks. And we have got a few questions, and I might go to one, because you were talking about maybe a peak 2026, 27, maybe into 28. There's a question here, and I'm not familiar with the reference, but we've got a question about, do you agree, Dave, with Phil J. Anderson and the 18.6-year cycle? And does the data indicate a correction in 26 to 28?
Well, the data doesn't indicate a correction yet, but we do look at his view amongst a number of others in the real estate cycle world, and then we have our own internal view. But he does influence it, yes. Yeah. And his view is that the market will peak December 2026, and I know that's probably out there in terms of being so specific, but that is his view, yes.
Yeah, great. And another question, commercial real estate market, specifically CBD office space. I know it's not necessarily an area that you work in, but do you have a view? And I'm prepared to share ours as well on that one.
It depends on the strategy. So if the strategy is a principal place of business and you're going to hold it for 30 years and it's in an SMSF, maybe you can justify it. But if you had options and it was a pure investment, it's probably not something that you'd do.
Yeah, and I think we're clearly looking at the rate space at the moment in the commercial office space, and leverage is the level of leverage is really important to consider, and the quality of the premises. I think those two things, you want high quality and low leverage at the moment in that space, would be broadly our view. If you're in that market,
I'm probably talking about the opposite end of the world, Lee, not the big end, but it's $5 million end, which is very different because a lot of it's strata. And if you're talking about buildings, there's opportunistic buys at the moment. Yeah.
David, can I thank you very much for your contribution today? It's really valuable, particularly in times of change, significant change, and the interest rate change is one of those moments to hear from you. And hear your views. Every one of our clients has exposure to the Australian property market, at least from a personal residential exposure, but often in from an investment perspective as well. It's great to hear what you've got to say. And if anyone listening in today has any questions about anything that David's presented, I'd encourage you to speak directly to your advisor, and they can facilitate an introduction to David if that's appropriate to continue the conversation. Okay. Well, thanks everyone for joining us today. We will circulate a video of this presentation for those of you online if you'd like to watch it again, and for anyone who missed it today. And finally, there will be a short survey following this presentation. So we really appreciate it again if you could take the time to give us a bit of feedback on the session today and anything else we can assist you with. Okay, I'll leave it there. Thank you very much. Thanks, David. Thanks, everyone.